I'm the head of ESG advisory at Goodbody Stockbrokers. And as I said, in a few minutes you're going to hear the perspective of investors and why this matters to them, why this subject, ESG, matters so much to them, how it's influencing their decision-making processes. I'm going to try in this short talk set the scene for that and show you the explosion of interest and appetite for ESG investment that currently exists, particularly in the European context, as Europe really is the most advanced region when it comes to ESG. Now, when we're discussing ESG, we've heard a lot this morning about the push factors, things that are driving your organizations towards ESG. There's the compelling moral argument, and Tom outlined some pretty stark statistics around why it's so important from a moral perspective. There's also the overlying regulatory argument. I mean, it's essentially a fait accompli. European regulators are going to impose ESG standards on corporates, whether they're wanted or not. So it is something that we all have to begin to deal with. But I want to talk about some pull factors, things that are attracting organizations to ESG, things that make ESG work right now for organizations. And when we talk about ESG investors, we used to call them SRI investors, socially responsible investors, but the advent of SFDR has changed that to a certain extent. SFDR, the Sustainable Financial Disclosure Regulation, has come up several times already, seeks to place investment funds in the European context into three different categories. Those are Article 6 funds, Article 8 and Article 9. Article 6 funds are funds which do not account for ESG in their investment strategy or decision making. It's not a factor for them. They make their decisions based on traditional metrics such as investment, such as return on investment and strategic priorities. And I'm fairly confident that if you were to audit the investment landscape of Europe in the 90s, virtually every single investment fund would have been an Article 6 fund. And thankfully, that's no longer the case. Now we have Article 8 and Article 9s. Article 8 are your light green funds. So these are funds that take ESG into account as a factor in their investment decision-making process. It's not the be-all and end-all, but it's very important and will influence the amount of investment you might actually receive or whether you receive an investment or not when you go out to market, whether it's equity or debt. Now, Article 9, you heard a bit about that from the NTR earlier. Article 9 is dark green. ESG is central to the investment decision. If your investment proposition does not have an ESG angle to it, you will not have access to Article 9 funds. So by having ESG as part of your investment strategy for gaining investment, you're giving yourself access to a wider investor base. You're bringing those Article 9 funds into play. You're giving yourself access to a deeper investor base by potentially getting larger and more significant investment from Article 8 funds. And you might say, well, there's a lot of upfront costs in dealing with ESG and in tackling the ESG subject. So why don't I just focus my efforts on Article 6 funds and that'll serve me just fine. Well, if you were to do that in the modern European context, in the modern European market, you'd be cutting yourself off from more than 50% of your potential investor base. A recent Morningstar report shows us that at the first half of this year, for the first time, ESG funds, your Article 8 and Article 9s, are greater than the Article 6. They make up 51% of the European investment market at 4.18 trillion. So a significant amount of investment will not be available to you if you do not have ESG as part of your strategy to gain that investment. A wider, deeper investor base increases demand. More demand, same supply, better pricing outcomes for you as an organization. It also helps to lower your execution risk. There's more demand and the same supply. The execution risk is a key risk that anyone has to manage when they go out for investment. That is the risk that you will not be able to execute the transaction that you need to gain investment. Having that wider, deeper investor base lowers your execution risk. These are two ways that ESG can really work for organizations right now, from a P&L perspective and from a risk management perspective. Now, in terms of fund flows that we've seen over the last 18 months, I think this chart, on the face of it, it doesn't look particularly interesting, but I think it is telling a very interesting story. You'll see at quarter 2 2021, when the market was much, much hotter than it is right now, that the fund inflows in Europe for Article 6 funds, the non-ESG funds, were greater than the ESG funds. People were happy to just throw money into those kinds of funds at that time. But as concerns, macroeconomic concerns, began to take hold, kind of in quarter 3 21, and also in quarter four, it accelerated. You're seeing that the fund inflows to the ESG funds are greater than the Article 6. There is more money still going to work for ESG than there is for non-ESG. As we enter 2022 and economic concerns really begin to solidify around inflationary pressures, the macroeconomic environment where there's potentially a global recession on the horizon, and also the war in Ukraine, we're beginning to see fund outflows. Now, in quarter one, a lot of Article 8 funds, that's the light green ESG funds, had to be redesignated as Article 6 funds because they weren't, in fact, fulfilling all the criteria that they had the ambitions to do. So that's why you're probably seeing a little bit of fund inflow to Article 6 and out of Article 8, but it's actually more reclassification. And I think if those funds that were reclassified meet their ambitions and go back to being Article 8, you'd actually see 8 having inflows and 6 having outflows. But very interestingly, in quarter two of this year, you're seeing that Article 6 funds versus the ESG funds are experiencing much greater outflows in the order of 6.4 versus 8.9%. But most interestingly, the Article 9 funds, the dark green funds where ESG is central to the investment strategy, they continue to receive more inflow, more investment. Now what this says to me, and anecdotally I can attest to it as well from bond markets, but what this says to me is that in a downturn scenario, you have a stickier cohort of investors for ESG. ESG investment is more likely to hold up well in a downturn scenario. And from working in bond markets for many years, I can say that when there is a sell-off, when there is a down period for a couple of weeks or months, funds are always selling off the conventional debt. They're never selling off the ESG debt because simply the demand for ESG debt greatly outstrips the supply. And if I sell it now, I might not be able to get it back then. So it always holds its value better. Typically trades, in the order of 5 to 10 basis points better than a conventional curve. And that's significant. It shows that in a potentially more difficult economic scenario that we could be facing into, having ESG as part of your investment gaining strategy will give you access to a stickier cohort of investors, a more supportive cohort of investors to help your business grow. Now, in terms of investor interest, where does it lie? Is it equity, is it debt, or what is it? It's primarily equity at this stage, but debt is a very close second. You see there, fixed income, that's debt, and then allocation funding, the light blue, that's a combination of equity and debt. In terms of gaining access to this equity investment, it's a little bit different to debt because, yes, you have to be part of the right financial exchanges, but ESG investors are extremely sophisticated nowadays, and they will make a full holistic assessment of your organization when deciding if you're going to gain an equity investment. Now, it varies from corporate to corporate and it varies from entity to entity, but there are certain underlying things that everyone should be doing to gain access to that, and that's, mapping out your scope 1, 2, 3 carbon emissions, setting yourself a net zero carbon ambition, applying science-based targets to that, and also what kind of reporting standards, the voluntary reporting standards, have you signed up to? And we're going into the S and the G space with that. Are you signed up for TCFD, which we've mentioned earlier, CDP reporting, the UN Global Compact, the UN Equator Principles? All this is things that equity investors, you'll have your credit analyst and you'll have your ESG analyst, and they'll be looking to see if you tick those boxes before they decide to make an investment in you. Remember, you're trying to target Article 8 and Article 9 funds here as well. So by having this stuff in place, you give yourself that wider, deeper investor base, driving price tensions and better investment outcomes. Now, debt is a bit different. It's much more structured. We have an organization, that's the wrong one, but we have an organization called ICMA, the International Capital Markets Association. Now, the International Capital Markets Association several years ago began putting together principles to define to create a more homogeneous approach to marketing ESG debt. That's in the space of social bonds, the social bond principles, the green bond principles, sustainability-linked lending principles, etc. And because we have these kind of standardized approaches in debt, now the holistic assessment is always there in the background. ESG investors, being as sophisticated as they are, will look at the overall firm, but you need to have these things in place to access the debt markets too. And there's modest costs involved in setting up this kind of thing, creating a framework, promising to do impact reporting. So impact reporting is a key area of debt investment. And impact reporting, say if it's in green bonds, you need to report on the carbon impacts of the investment, how much the carbon is reducing thanks to the investment you've gained. If it's social, it depends on what aspect of the social agenda it's focused on. Say if it was healthcare, how many more people are able to access treatment as a result of investment? If it's focused on social housing, how many more people have a home thanks to the investment that you've been making? So impact reporting is important, and that there is investment required for that. But if you're issuing this type of debt versus conventional debt, you can expect to make a saving in the region of 5 to 10 basis points, which on the face of it doesn't sound like a lot, but if you're doing a large debt transaction, that means you've more than paid for the cost of setting up a green or a social or a sustainable debt program, and you've actually gained yourself access to a stickier, more supportive investor base. And one area of sustainability debt finance that is of particular interest these days is sustainability-linked loans. Institutions here in Ireland, and Aidan talked about in the Bank of Ireland context, and AIB are very much involved in this area as well, is where they will offer corporates who put in place sustainable KPIs, so key performance indicators for you to do with sustainability, whether it's environmental or social targets. Typically how it works is if you set 5 KPIs that you have to hit every year, you get a 5 basis point reduction. You could set 10, get a 10 basis point reduction, something like that. It's showing that the financial market is putting its own P&L to work to support corporates who are good actors in this area. So if you're a firm who's already across ESG and already on top of ESG, and you set yourself metrics and targets internally, use those metrics and targets to access cheaper and better funding and drive your P&L. And interestingly, actually, in sustainability-linked lending, a recent feature is that where firms are not hitting the KPIs that they've committed to hitting, they're actually receiving that interest back from their lender. The lender doesn't take that interest off them, it gives it back to them and says, well, take that money and go and invest it in yourself in such a way that it remedies your missed KPI. I think that's very significant. It shows that not only on the debt capital market space or in the equity market space, but in the institutional lending space, there is access to better funding, better debt that can drive your P&L. Now, to give you a sense of the total scale of ESG debt investment, because ESG debt investment is a lot easier to track with these dedicated products versus the more holistic equity investment portion. You can see here the growth of the ESG debt market over the last 8 years or so. It's grown by more than 50 times in less than 10 years. There was 1.6 trillion of ESG bonds issued globally last year, according to Bloomberg. And that's more than doubled what was done in 2020. Remains dominated by green bonds, but you can see sustainability-linked lending has really jumped up as well. Sustainability-linked lending has become a significant factor in this area. And it didn't even exist prior to 2018. So we're quickly advancing, creating new products and new opportunities for corporates and organizations to gain better access to funding, better access to capital, and therefore drive better P&L outcomes for their organizations. So in summary, what I'm really trying to say with this talk is that while ESG, yes, it is absolutely essential to the future of your organization from a climate crisis and regulatory point of view, it can be made to work for you in the here and now from a P&L perspective. It can also lower your execution risk by taking account of things like supply chain risks. You can lower the possibility that you'll be targeted by climate activists. You can gain positive publicity. So there's intangible benefits as well. But the real tangible P&L benefits and execution risk are already there, and they exist. ESG, by giving you access to that wider, deeper investor base, it creates price tension, leading to better investment dynamics for good ESG corporates. It's well worth investing in ESG now. Regulators are going to make organizations do it anyway, but if you're doing it now and doing it right, it can actually contribute to your P&L, and it can contribute to the stability of your own funding and investment profile. And with that, I'll give it back to Aidan for the panel discussion. Thank you.